In today's video, I am going to show you how you can still make money through smart decisions, even when the market is falling. And if you're wondering where to invest when the RBI starts cutting interest rates, I have got you covered. So stay tuned till the end. Hey everyone, welcome back to the channel. If you're new here, I'm so glad you landed in this space because today's video might completely change the way you think about investing in falling markets. We all know how it feels when the market is in the red. Portfolios are bleeding, panic sets in, and most people freeze. But what if I told you there are smart ways to actually make money when the market is falling? So let's dive in and bust the first myth. Just because the market is falling doesn't mean you have to lose money. In fact, smart investors do not panic. They pivot. They shift money into assets that benefit from falling interest rates and rising uncertainty. And one of the best examples of this is long-term GILTBEES, an ETF that tracks long-term Government of India bonds. We will cover everything in detail, including whether you should invest and when to invest. I know, yes, it's a mouthful, but trust me, by the end of this video, you will not only understand what it is, but also whether it is the right investment for you. Before we dive deeper, let me first present the historical growth chart of long-term GILTBEES. Over the past 5 years, it has delivered an impressive return of over 34%. Even during recent times, when our portfolios have been underperforming, it has still managed to achieve a 3% return in the last month alone. So what exactly is long-term GILTBEES? It's an exchange-traded fund, or ETF. Think of an ETF as a basket of investments that you can buy and sell on the stock exchange just like a regular stock. In this case, the basket is designed to mirror the performance of the Nifty 8 to 13 year G-Sec index. And what's that index? It's made up of Indian government securities. So these are basically bonds issued by Indian government to borrow money. The 8 to 13 year part tells us that these are the bonds with a maturity. That's when the bond is paid back of between 8 and 13 years. In a sense, when you invest in long-term GILTBEES, your money is used by these government bonds. The government uses that money and in return promises to pay back the principal, the original amount, along with interest. So, to give you a clear picture, let's look at the typical holdings of long-term GILTBEES. You will see it is heavily weighted towards Government of India bonds. Here is the breakdown. As of March 2025, the top holdings in long-term GILTBEES include 6.79% Government of India bonds, which has got a weightage of 4.18%, 7.10% Government of India bonds with the weightage of 27.39%, 7.18% Government of India bonds got a weightage of 25.67%, and rest is in the cash. So now, this isn't a static picture. The specific bonds with long-term GILTBEES change over time. Every month, the fund managers adjust the holdings based on how easy it is to buy and sell a bond and how much of that bond is available. Also, as bonds get closer to the maturity date, they eventually fall outside that 8 to 13 year window, so they are replaced with the newer bonds. Alright, so coming back to the main question, when might you consider investing in something like long-term GILTBEES? Here are a few scenarios. Falling interest rates. So if the overall trend is for the interest rates to go down, long-term bonds become more attractive. So when new bonds are issued at lower interest rates, the older bonds with higher rates become more valuable. Negative stock market sentiments. When the stock market gets shaky and investors are fearful, there is often a flight to safety. People sell their stocks and buy safer assets like government bonds, which can push bond prices up. Diversification. Long-term gilbees can be a good way to diversify your portfolio. If your investments are all in stocks, adding some bonds can help cushion the blow when the stock market declines. Long-term stability. While bond prices do fluctuate, government bonds are generally considered less risky than stocks and can provide more stable returns over the long term. It's really important to understand what can affect the price of long-term gilbees, and here are the key factors. Interest rate movements. This is the most important. Remember, bond prices and interest rates move inversely. When interest rates go up, bond prices go down, and vice versa. And because long-term gilbees holds long-term bonds, it is very sensitive to these changes. Even small rate hikes can cause the value to drop. RBI's monetary policy. The Reserve Bank of India plays a big role. Their decisions about the repo rate, the rate at which banks borrow from the RBI, and the reverse repo rate, the rate at which the banks lend to the RBI, directly impact interest rates and bond prices. Their actions in the open market, buying and selling government securities, also have an effect. Government borrowing program. When the government increases its borrowing, it issues more government bonds. This increased supply can sometimes put downward pressure on bond prices, meaning yields will go up. Inflation expectations. If investors expect inflation to rise, they will demand higher returns to compensate for the decreasing value of their future payments. This can also lead to lower bond prices. Global economic factors, where what happens in the global economy matters too. International interest rates, trends, and how investors feel about the global economy can indirectly influence demand for Indian bonds. And of course, there are costs involved in any ETF. And for long-term gilbees, the current expense ratio is around 0.10% per year. This fee covers the fund's operating expenses, things like management fees and administrative cost. While 0.10% might even seem small, it is important to remember that it is an ongoing cost and it will slightly reduce your overall returns over the long term. It's lower than what you would typically pay for an actively managed mutual fund, but it is still a factor to consider. Alright, coming to the big question. Is long-term gilbees right for you? So who should consider long-term gilbees? Long-term investors. If you have a long investment horizon, you are better positioned to ride out any short-term fluctuations in bond prices. Interest rate, risk tolerance. You need to understand and be comfortable with the fact that bond prices can go down, especially when interest rates rise. Diversification seekers. If you're looking to add some stability and diversification to your fixed income portfolio, long-term gilbees can be a very useful tool. Alright, here are a couple of ways to use long-term gilbees strategically. Rate cut anticipation. If you believe the economy is slowing down and the RBI is likely to cut interest rates, consider starting a SIP in long-term gilbees to benefit from potential price appreciation. Include long-term gilbees as part of your overall debt allocation within a diversified portfolio. Then, as market conditions change, rebalance your portfolio, meaning sell some of what's performed well and buy some of what has not, to maintain your desired asset allocation. Alright, So let's dive into some historical performance of long-term GILTBEES. To give you some real-world context, let's look at historical performance. 2020 COVID crash. When the COVID-19 pandemic hit and markets crashed, long-term GILTBEES delivered returns of around 12 to 14% as investors sought safety in government bonds. 2015 to 2016 rate cut cycle. During this period, when the RBI was cutting interest rates, long-term GILTBEES also provided strong double-digit returns. So historically, it has done well when the interest rates fall or when there is a fear in the market. So it is helpful to compare long-term GILTBEES with other common debt investment options to get us the clear picture. And here we go. So this is how the long-term GILTBEES looks like. It is very low in risk and very high in liquidity. It means that you can actually buy and sell long-term GILTBEES at any point of time. So long-term GILTBEES scores high on safety, liquidity, and tactical growth during rate cuts. Alright, so we have learned everything about long-term GILTBEES. Now coming to other question, how to buy it. If you decide to invest, you can buy long-term GILTBEES on the NSE and BSE using its ticker symbol, which is LTGILTBEES. You will need a demat account, and you can easily purchase units through online brokerage platforms like Zerodha, Grow, and many others. Just like buying stocks, the price of long-term GILTBEES units will fluctuate throughout the trading day. So let's do a quick recap about what we have learned so far. Long-term GILTBEES can be a good way to reduce the risk in your portfolio, especially when the stock markets are volatile. It's a low-cost and a relatively safe way to invest, and it can offer moderate returns. It tends to perform best when the interest rates are falling or during times of economic uncertainty. It's suitable for investors who have a tactical approach to the market or who prioritize conservative investments. Alright guys, that's it for today's video. If this helped you understand a new strategy for investing during tough times, give this video a big thumbs up. And do let me know in the comments, have you ever tried investing in debt ETFs or long-term GILTBEES before? And please don't forget to subscribe, because I'll be breaking down more such investing ideas in upcoming videos that you won't want to miss. So until next time, invest smart, stay informed, and keep building that financial freedom, and see you in the next one.